Good morning. My name is Robin Miller, and I'm Senior Corporate and Tax Counsel for Pro Bono Partnership of Atlanta. Welcome to our monthly webcast. Today's topic is maintaining your tax-exempt status when you have close ties with a separate for-profit. Now, I'm not talking about a relationship where the tax-exempt or 501c3 organization is the sole owner of the for-profit, or even where the two entities are part of a larger, more complex set of organizations with a parent and maybe their brother-sister entities. I am talking about organizations that are entirely separate from one another, but have a close sort of ties and intermingling of their relationship. And that's what we're going to cover today. But before we get to that, I want to share with you a little bit, if you're new to our webcast, a little bit about the mission of Pro Bono Partnership of Atlanta. So we provide free legal services to small nonprofits that serve low-income or disadvantaged individuals that are located in the greater metropolitan Atlanta area or that serve the greater metropolitan Atlanta area. And we do this by matching them with volunteer attorneys who are from leading law firms or corporations, and those attorneys help with the nonprofit's business legal services needs. To become a client of Pro Bono Partnership of Atlanta, you need to be an existing 501c3 organization, you need to serve low-income or disadvantaged individuals, and be located or serve this area of Metro Atlanta. If you're interested in becoming a client, please go to our website where you can find our request for legal assistance. But in addition to that, we have all of our webcasts are listed on our website as well as on our YouTube channel. And we also have hundreds of articles on our website on various different topics. So if you're interested in learning more about another legal topic, you can always go to our website, and that's listed on this slide. The next slide generally says that I'm about to give you general information and not specific legal advice, and it describes our copyright notice for these materials and for our webcast today. All right, now let's get to the topic at hand. For this topic, I felt like the best way to explain it was to do it in a series of scenarios, and then break down those scenarios by the three different areas of the law that come into play. So I'm going to start with this first scenario and walk you through it. So we've got Charity A that provides free counseling services to low-income individuals. And 5 years ago, Charity A was founded by Jesse Smith. He is the owner of a for-profit organization or company called Counseling Services. Jesse found that there were lots of low-income individuals who wanted and needed counseling services from his for-profit counseling services, but he really couldn't provide it to them because they couldn't afford to pay. So he created Charity A with the thought that those with needs for counseling services but who could not afford to pay for them might be able to get them through Charity A. All right, so here are some of the factors that you need to know, and we're going to change up these factors a little bit as we go through the presentation. Counseling Services provides Charity A with space. Counseling Services provides Charity A with an employee. Counseling Services donates money to Charity A. And Counseling Services and Charity A send clients to one another. So that's our scenario. We've got Jesse, we've got Charity A that's been around 5 years, and he's sort of connected strongly to both entities. And as you can see, there's this sort of interconnectedness through a variety of scenarios, and we're going to get through those and talk about the implications of each of those, or the things that you need to think about when analyzing your particular situation. All right, so there's three main tax concepts that we're going to go over, and I'm going to get into some of those in detail, some in more detail than others. The first one is private inurement. Then I'm going to talk about public charity status. And then finally, private benefit, and what each of those means and why they're important when we're talking about this sort of interconnected relationships with these two types of entities. All right, let's start with private inurement. So what is private inurement and what is it about? Well, the first thing you need to know is that it involves insiders to the charity or 501c3 organization. So anyone who's an insider, and this slide kind of defines it, is going to be the founder, the officers, the directors, substantial donors, sometimes senior employment or employees can be considered insiders, but it's anyone with control or influence over the organization. And then it also includes their family members, and it goes back 5 years. So it can be quite an extensive group that are considered insiders to an organization when you're thinking about private inurement. And so you have to have that context. So what is private inurement itself? Well, private inurement involves providing a benefit to an insider that's beyond what the insider is giving back to the charity. And that sounds kind of amorphic, so we'll come up with a few examples to help you understand that. A really simple one is the organization makes $200,000 a year in gross revenue, and they're paying their CEO $150,000 of that. That's probably more than a CEO of an organization that size should be paid. And so in that case, you've got, and the CEO also happens to be the founder. So now you've got a clear insider who's getting paid from the charity probably more than they should be. And that would be constitute private inurement. So what's the risk of that? Well, the risk is you could lose your exemption, or you could face intermediate sanctions. And intermediate sanctions came into being in the Internal Revenue Code and regulations in the 90s with the concept that there might be some bad apples who are improperly influencing the organization and are getting some kind of improper benefit out of the organization. But really the organization's mission and goals and what it does is really good, and we don't want to impact its mission and the good work that it's doing. So we want to go after the bad apples and the bad actors. And that includes sort of two categories. One is the insider who's receiving that excess benefit. And the other is the organizational managers who approve that excess benefit. So there's penalties that are imposed upon those two under intermediate sanctions. And it allows the organization to continue operating. So the penalties get pretty stiff pretty quick. So in my scenario where let's say it's been determined that in fact it is private inurement because others are getting paid in a similar situation much less, and let's say they're getting paid $100,000 as opposed to $150,000, just for round number's sake, then the insider has to pay back the amount beyond which they should be compensated, so $50,000. And then in addition, there's a 25% penalty personally on that insider, and that's 25% of the amount overpaid. So it's 25% of the 50. So they would owe $12,500 in a fine, essentially, or a penalty to the IRS for getting private inurement or receiving private inurement. If they don't pay back the $50,000 and address this in the same tax year in which they receive it, that penalty goes to 200%. And so if you think about it, okay, if it's $50,000, that means they owe, in addition to paying back the $50,000, $100,000, which is basically all the money that they receive from Charity AO, or from their charity for that year. So you can see how it becomes pretty quickly very exponential. In addition, the organizational managers, those who agreed to that amount, can also personally be liable for a fine, and that is 10% of the amount that the individual the insider received beyond what they should have received. So in the $50,000 overpayment example, they would have to pay the $12,000, or they'd have to pay $10,000, or 10%. They'd have to pay $5,000. Sorry, as a penalty to the IRS for agreeing or allowing that private inurement transaction to take place. The big picture that you need to think about here when you're talking about private inurement is basically make sure that you're doing your due diligence to make sure that if you are paying someone who's an insider some payment for services, for as an employee, or for a contract to do some work, or whatever the case may be, a lease, that it's reasonable. And under intermediate sanctions, there is what's called the rebuttable presumption of reasonableness. And what it does is it says, look, if the organization does its due diligence and it does a comparison, how much are other people paying for leases of a similar size in a similar area? How much are people paying their executives? What is an organization in the same geographic area of a similar size doing similar work paying their executives? And if they gather up that information and then make a good decision based on that information, it's presumptively reasonable. And then it's on the IRS to prove that they didn't act reasonably and that they didn't make a decision that was in a reasonable amount, constituting private inurement. So there's this sort of safe harbor that exists in the intermediate sanctions rules that you can apply. So if you're going to be working with an insider in any way as a 501c3, and this does come up in this scenario, and we're going to get to our original scenario in a second, make sure that you're gathering your data and making really good decisions based on other similarly situated organizations or other, options out there like lease options and things like that. All right, so now let's go back to our original scenario. We were talking about Charity A and our counseling services and Jesse Smith and his counseling services company. All right, independence when you've got these two entities like this is critical to success. There's nothing inherently wrong with having counseling services and Charity A. But you want to make sure that there's a level of independence between the two entities, particularly because you've got Jesse Smith, who's kind of on both sides of the coin. So the first question is payment for rent. All I said was that counseling services was providing space. So then you have to ask, well, are they paying rent? Is Charity A paying rent to counseling services? If counseling services is providing the space for free, clearly not a problem. But if Charity A is paying rent to the founder's company for the space, then you got to look at, well, is it a good deal for the charity? Is it not? You got to look at some comps, what it would at least cost in that area, or is there a better area that they could be in that's cheaper that they need to be considering? And that's that rebuttable presumption of reasonableness that I just talked about. So you want to do that due diligence and make sure and document that you did it as an organization, as Charity A. You want to document that you actually looked at this and made good decisions and that it is a reasonable transaction. Because if it's not, you could be in the private inurement basket and you don't want to be there. The next thing from our scenario is payment for an employee. So is counseling services charging for the use of that employee? And if so, how much? And do you really need to pay that person that much? What is the benefit there? And you have to do that same kind of analysis. Does this make sense? If this were an arm's length transaction where you didn't know anybody from counseling services and they were still providing this benefit, does this make sense for Charity A to be engaging in this activity? And is it the best option for them? The last issue that comes up is the referral to counseling services. And this is really where it can get dicey. So it's fine for counseling services to send people that can't afford their services to Charity A. That's not a problem. But Charity A sending clients that can pay, maybe somebody reaches out to Charity A and they realize, oh, you're above our minimum, you can afford to pay for these services, and they're sending them over to counseling services, that could very much be a problem. And one of the key questions is, well, are they sending them to others as well? I mean, it's natural for them to think about, oh, well, we'll just send them to counseling services. But really what they need to do is have a list of a variety of counseling services that are available that person could choose to go to, and to not just be directing people to counseling services, because that's a big benefit to that for-profit, with the founder of Charity A being the owner of that for-profit. So you need to be really careful, because that would constitute, if they're only sending people to counseling services and they're doing it even on an irregular basis, but definitely on a regular basis, then you've got some real private inurement concerns. And of course, we don't want the charity to lose its tax exemption because of this relationship or have these intermediate sanctions apply. So that's the first topic, the first legal topic that really comes up when you've got these close relationships. The next one is your private charity, private foundation status. This one is really complicated, and I'm going to do my best to try and make it not too complicated, but there's a lot of information here. And I'm going to kind of go over the rules and what the different categories are, and then at the end of the day, probably tell you to talk to your accountant if you think there's an issue. But oftentimes, first of all, 501c3 organizations are classified as either public charities or private foundations. And that's under another code section. That's under code section 509A. And your determination letter that you should have, that you receive from the IRS, in the right-hand corner has sort of a table. It's not actually a good table, but there's a list of different aspects of your tax-exempt status. And one of them states whether or not you are a public charity or a private foundation, and it lists what code section you fall under. And you may have never really paid much of attention to that, but it is important, and it's important to know not only for this purposes of these close relationships, but in general, what your public charity status is, and ensure that you're meeting that public charity status requirement. Because if you're not, you can become a private foundation, and that's not a place you want to be, unless you purposely choose to be that. Most of the charitable 501c3 organizations we work with would be very unhappy if they found out that they were a private foundation. And we'll get into a little bit more of that as I talk through this. All right, so public charities. So public charities, under 509A, there's 4 code sections within that. There's 509A 1, 2, 3, and 4 that all address public charity status. And they coordinate also with another code section because, you know, the Internal Revenue Code just can't be more complicated. So there's 170B1A that also plays into all of this. And I know that's many more code sections that you want to hear about. But you kind of have to talk through it to understand these different options. So the first option there's 2 different options under 509A1. There are statutorily classified public charities, and then there's this other group called publicly supported public charities. Statutorily classified are found under that 170B1A section, under sections 170B1A1 through 5. And those include things like churches and schools and hospitals, and they're specifically delineated in the code section that you are a public charity if you are those things. Under each one is under a specific code section. But then there's also this sort of catch-all that's in 170B1A6, and it is that you're publicly supported. And most of our clients fall under this, so it's 509A1, and it's section 170B1A6. So if you look at your little section on your determination letter, that's often what you'll see. And the rule to meet this requirement is that 1/3 or more of your support comes from gifts, grants, and contributions from governmental agencies, contributions from the general public, and contributions from other 501c3 charities. And that's the general rule. Now, there is another option there, and it's called the 10% facts and circumstances test. And it's really not where you want to be, but it is a backup if you're not meeting that publicly supported test. But it puts you in a situation where the IRS has a lot more say about whether or not you meet your public charity status, and you'd rather not be there. You'd rather it be very clear that on paper you meet the public charity status. So in the 10% facts and circumstances test, basically they say, look, you're getting 10% of your funds as publicly supported. But it's clear, and that it's coming from 10% of your support is coming from governmental agencies, from other 501c3 public charities, and from the general public. Plus, the facts and circumstances as to how you operate show that you're a publicly supported organization. You'd really rather not be in that test. You really want to find yourself in the 1/3 test and be able to prove that. I want to give you an example of a publicly supported organization to kind of help you have a better feel for what I'm talking about and materialize this. So at the bottom of that slide, a human services organization whose revenue is generated through widespread public fundraising campaigns, from federated fundraising drives, and from grants from other public charities or the government is a publicly supported charity. And there's a whole calculation that you do, and we're going to get into that as to how to figure out whether or not you're meeting that 1/3 test, because there's other factors that affect that 1/3 test that we also have to talk about. And those other factors also tie very closely into this whole concept of these interrelated entities. But there's two other categories I need to briefly mention. So the next category falls under 509A2, and it defines another category of public charities. And those are service provider public charities. So basically, in this case, you have to receive more than 1/3 of your support from gifts, grants, and contributions, like the other one, but also you can receive it from admissions, from merchandise sold, or services provided. So this is another category of public charity where maybe your income isn't just from gifts, grants, and contributions. It's from some of the work that you do, the services you provide, admission to your facility. And this test has another category aspect to it. And in that case, not more than 1/3 of your support can come from your investment income or from unrelated business income. So it's more complicated. You get more income that you can include in your bucket for 1/3 to meet your 1/3 requirement, but then you got some restrictions. So an example of this, there's actually a couple examples listed here. First might be a membership fee organization, like a parent-teacher organization where you pay to be a member, and so some of the income is coming in through that service, that payment for membership. Or another example might be an arts organization with box office. So maybe it's a theater that is a 501c3 organization, or a dance organization, and so they're getting revenues from you attending. That is included in that 1/3, and so they might be classified as a service provider public charity under 509A2. The last category of public supported or public charities is 509A3, and that involves supporting organizations. And I'm not going to even talk about that because that's a whole other quagmire that really doesn't apply to the circumstances we're talking about, where we're talking about for-profits and nonprofits that have sort of interactions on a regular basis. Right. I do want to briefly mention that it's really important, and you really prefer to be a public charity than a private foundation. So, and that's true for a variety of reasons. One is that private foundations are not nearly as attractive to donors. In general, private foundations are organizations that have a good mission, and they're serving some kind of charitable mission, or something under 501c3, some exempt purpose. But they're controlled by a small group of people, and oftentimes the income or money for that organization is coming from a very small group of people. A couple examples: the Bill and Melinda Gates Foundation. It's doing great work, it's performing incredible exempt function activities, but all the money comes from Bill and Melinda Gates, or most of it. In addition, the Ford Foundation is another one, the Rockefeller Foundation. There's tons of private foundations out there, but they're controlled by a small group of people, and most of the funding comes from a small group of people. And so for new 501c3 charities that want to be public charities, but have another, like a for-profit that's sort of connected, you got to look at, well, where's the income coming from? And is it primarily coming from this for-profit entity, or is it primarily coming from your founder? And this is often an issue with smaller, newer 501c3s, but it's particularly an issue when you've got this close relationship with a for-profit business, and you really have to keep an eye out for that. And we're going to walk through that in a little more detail. This slide also, though, talks about if you are a private foundation, what additional requirements you have. And it's extensive. Because it's such a small group of people controlling the entity, they have a whole lot of additional rules and responsibilities that they have to meet. And a lot of those are listed here. And I'm not going to go into those details because that's an issue for another day. And we don't represent private foundations. So you don't need to know that on this webcast. But the overarching concepts are there. All right, so now we've talked about that you have to meet one of these different public support categories. Now we're going to talk about how you actually calculate public support. And I'm not going to give you every detail of what that takes, but I'm going to give you an overview, and I'm going to tell you you need to reach out to your accountant and make sure that you really understand this concept and that it's being done correctly and where you stand as an organization with regards to your public charity status. And this is true regardless of whether you work with closely with a for-profit. It's really important to understand your public charity status and where you are in the calculation and whether you're meeting that 1/3 support test. And then the case of an organization that also receives admissions or money from services, whether or not you're meeting that 1/3 restriction as well. So, Schedule A of the Form 990 is a schedule that you should definitely take some time to look at and understand, including the instructions. You really need to be wary of a concept called tipping, and that's where a majority of your income is coming from one source, because that can tip you into private foundation status. And once you're there, it takes years to get out of it, so you don't want to go there. But it doesn't happen immediately, and we'll talk about that as well. And that's really the benefit of getting to know Schedule A, because you can do an analysis and kind of figure out where you are as an organization and keep track. Because the first thing you need to understand is the first 5 years you kind of get a buy. You get time to make sure that you're meeting the test. However, when you complete your application for exemption, you complete a form, the financial section. And in that financial section, you're showing where you expect your income to come from. So the IRS may look at that and may initially say, you're not looking like you're going to be a public charity, and we're thinking you're going to be a private foundation, and that's what we're going to categorize you as. So you really want to pay attention to how the IRS has categorized you, and you want to show that you are in fact going to be a public charity and you're going to meet one of those 1/3 tests. Or you're statutorily meet the test, which makes that very easy. But most of our clients do not fall into that statutory categories. So,
question, Robin. When you say tipping and majority of income, is there a percentage, or was majority, is it just 50-50? Or
no, you actually have to go through and run the calculation. So if you're getting a significant portion of your income from one person, you have got to get through this public charity status analysis and look at Schedule A and meet with your accountant and understand. There's two different aspects that we're still going to talk about, where there's a 2% limitation as well as an unusual grant scenario. And those are also additional factors that have to be considered when doing your public charity status analysis. So you can't, it's complicated. It's probably the most complicated analysis that a 501c3 public charity has to go through, is to make sure that it's meeting that test. So if you've got significant donors like that, you really need to go back and look at and analyze all of your public support and make that decision. So there isn't one clear answer to that question. But it's a red flag, and it's a red flag for next steps to take. Your first 5 years, you kind of get this buy, and in year 6, it counts. However, like I said, you really want to be on track and show that before year 5, you are meeting that public support test. Because if you're not, then it's not like magically all of a sudden by year 6 you're suddenly going to meet it. So you really need to be working towards that in your first few years. The IRS is basically giving you a little time to ramp up and get in position, but you want to be well in position by year 5. But here's how the rule works. If you meet the public support test for a tax year, then you're treated as a publicly supported charity for that year and the succeeding year, regardless of whether you actually meet it in the succeeding year. However, if you don't meet it in the year after that, and you didn't meet it in the year before, you lose your public charity status. And this is not something you want to play with. You really want to meet it every year and know that you're there. So the concrete example is if you meet it in year 7, then you're treated as a public charity in year 8. However, if you don't meet it in year 8, and then you don't meet it in year 9, you've lost your public charity status. And every year you have to run that calculation and submit it on your Form 990. So it's really important to pay attention to this. All right. I mentioned that there are 2 other factors that can come into play. The first is excess contributions. So let's say you do have this major donor who's contributing a substantial amount of your money, and maybe it's the founder, right? Which goes back to our whole concept of these closely related entities. Or maybe it is that for-profit entity that's giving a substantial amount of money. Going back to scenario 1, maybe counseling services is providing a substantial amount of money to Charity A. So the way this works, and I'm not really going to be able to go through every level of detail on this. Like I said, you've got to sit down, you really have to analyze it and make sure you're meeting the test. And I recommend that you do that with your accountant who completes your Form 990. So, excess contributions, where you have a contribution that exceeds 2% of your total support over a 5-year period. Those excess contributions will be removed from only one part of the public support test analysis. So the amount is still included in the denominator in that percentage calculation, but it comes out of the numerator, which makes it even harder to meet the public support test. So now, there are certain situations where if you get money that's in excess of 2% of your total support for a 5-year period, it doesn't matter, it doesn't count, it still stays in the numerator. And that's if you're getting money from other 501c3 public charities or governmental units. And that includes the statutorily identified public charities. So if you get a big grant from another public charity, you don't have to worry about this 2% excess test. That doesn't apply. But if you get it from an individual or another donor of some sort, it will apply, and you have to really carefully look at it. So I want to walk you through an example. Charity C earns $100,000 a year in each of 5 years, totaling $500,000. That's their total support for 5 years. Jolene Michaels gave Charity C $10,000 or more during that 5-year period. Jolene Michaels' donation is above the 2% limit if it's at the 2% limit at $10,000. If she gives more, then it's above, and it has to be excluded from the numerator in doing the calculation of whether you're meeting your 1/3 test. But it stays in the $500,000 amount. So you've got to be really careful because it will affect your ability to meet that 1/3 test. There's another area that's actually a benefit in this arena, because that affects and reduces your ability to meet your 1/3 test. So you want to be careful about those donations. And the critical element here is to get donations from a wide variety of sources. If you're getting income from a wide variety of people and sources, and that gets you to that 1/3, you're in good shape. Usually if you're doing a couple fundraisers a year and raising a decent amount of money through that, then you're covered through sponsorships or other ways that are, a larger number of individuals or companies donating to you. But let's say you get this really large amount from one person or one company, and and you want to figure out, well, maybe we can call this an unusual grant. And if it's an unusual grant, and that's actually a term, a real term in the code, and it's on the form Schedule A of the Form 990, but an unusual grant is defined and very specific. And it's a grant, and if it is considered an unusual grant, then it falls out not only of the numerator, but the denominator too. So it's almost like it was never given to you. So it's not even included in that public support test analysis. So how do you categorize something as an unusual grant? Well, first of all, it can't come from an insider. It has to be from a disinterested party. So if you have a for-profit that's just that's entirely separate from your charity, but that really likes the work that you're doing, and they give you a huge grant or a huge amount donation, but they're not connected because it has to be a disinterested party, then that might qualify. It also has to be that they're giving it to you because they really love your mission and they believe that you're doing really good publicly supported work. It's also unexpected, and it doesn't happen over and over again. And then finally, that by reason of this large amount, you wouldn't receive your public charity status. So if you have all of those factors, then this can be classified as an unusual grant. So let's talk about an example. You get a donation of $100,000 from a disinterested person to the organization, and the organization in this case helps the homeless. And the organization has annual revenues of $300,000. And so your unusual grant is based on an annual look, not the 5-year. So the contribution is substantial, and it is unusual in its amount, right? It clearly falls into that category. It's given due to the fact that this donor has decided that they're really excited about the homeless work that this organization is doing, and the organization isn't going to meet its public support test because of this large grant. So and so it's deemed to be, or can be deemed to be, an unusual grant, and then it's not even calculated as part of the public support test. So that is a sort of a relief mechanism that you may find yourself in for a one-time disinterested donation.
Robin, we have a question. What if your organization files 990Ns and has for 5 years or more without Schedule A attached?
You still need to take some time to look at that Schedule A and work through that. And that is the risk of the 990N, is that you're not paying attention to this and you're not looking at where your funding is coming from. And it is still really important to make sure you're complying with the public support test. Because in most situations, your goal is to grow. And to not be filing that 990N, but to file a 990EZ and maybe even a 990. And either way, even if you stay filing the 990N, this public support test is still an obligation of yours. And you still have to meet that test requirement. And you still can lose your exemption or become a private foundation if you don't. All right, so now let's go back to that original scenario we started with. And now we're going to look at it as a modified scenario. 1. So we've got Charity A that provides the free counseling services to low-income individuals. 5 years ago it was set up, and now you know why that 5 years is important, because we're looking at that 6th year when it really counts, and we need 5 years of income. And it was founded by Jesse Smith, and he's got the for-profit counseling services, and we know that that he's sending low-income individuals to Charity A because he can't help them. So counseling, now here's our different factors. Counseling services provides Charity A with free space. Counseling services provides Charity A with an employee for free. Counseling services donates a significant amount of money to Charity A. And counseling services and Charity A send clients to one another. All right, so now let's analyze this. Well, we know that Charity A is I'm going to tell you that Charity A in this case is a public charity under the publicly supported test. So that's under the 509A1 category, under 170B1A6, that catch-all. And so under that rule, they must receive a third or more of their support from gifts, grants, or contributions from government agencies, the general public, and from other 501c3 organizations. So we've got to analyze the income that Charity A is receiving from counseling services because of this closeness, right? That's why this is an issue. And that's why we're talking about this. So they've been in existence 5 years, so the public support test must be calculated for the next year. We really want to make sure you're on track. So you've got to look at, well, could this be an unusual grant? No, because it's not from a disinterested party. So that falls out. Well, 2, what is the effect of the 2% limitation on the public charity status? And so in determining that calculation, you have to look at all the different forms of benefit or donation that's being provided and what's included in the calculation and what is not. You have to look at, well, you know, is the free rent included as part of the in-kind donation? Is that included in the public support test? Is the free employee, which is also in-kind, included in the public support test? And then, of course, there's the actual big donation that was made. And so you really need to look at that Schedule A and work with your accountant and determine how that's going to affect your meeting your public charity status. There's not one clear, simple answer that we can give you, so you've really got to take the time to run through the analysis, and it is important because you don't want to end up being a private foundation. All right, we're now at the last part of the 3 parts of the legal issues that are commonly found when you've got a for-profit that's sort of interrelated or intermingled with a nonprofit or has a lot of combined energy. And that is private benefit. Now in this case, private benefit is a similar concept to private inurement, except that we're talking about disinterested parties, and it's a little bit different. So in private benefit, there's 2 different concepts. The first is the concept that you have to have a significantly large charitable class. So the example is, one of the famous examples was there was an organization that was trying to be set up and asking to be recognized as a 501c3, and its exempt purpose was that it was going to assist this family and it's all of its extended family members, and it existed to help that family and its extended family members, and it was about 100 to 150 people, and the IRS said, no, that's not an exempt purpose. You're helping a family, that's private. So they said, you don't meet the public, you're not complying with the public benefit requirement. And you have private benefit going on here. You're privately benefiting a single family. And so I've had some clients that say, well, but we only serve like 40 children. And they're all at-risk children. I mean, they live well below the poverty line, and we're there to help them with after-school activities and mentorship and other things. And that's okay, because unfortunately, there's many more kids that fall into that category that could be served. Just because you can only serve 20 to 40 of them, because that's your resources are limited, doesn't make it private benefit. Your class of people that you could serve is sufficiently large, even if you're only serving a small portion of that class. There's lots, unfortunately, there's lots of kids that fall into your class. So you have to look at, are you serving a private benefit, some small group of individuals only? But you also have to look at whether you're giving a benefit to a private individual that is beyond what they deserve for what they're giving you back in return. Does that sound like the private inurement scenario that we talked about before? Yes. And the difference here is that it's with a disinterested party. So a good example is a fundraiser that you hire. You hire a professional fundraiser, and at the end of the day, the professional fundraiser makes 80% of all the money, and you get 20%. That is not appropriate, and that is private benefit to the professional fundraiser, and the Supreme Court has said so. So that's a good example. So you want to make sure that the deals you're entering into with disinterested parties doesn't create private benefit. So when you're working with an organization, a for-profit business, and there's these close ties, that's where this can come up. So now I'm going to give you scenario 2. Scenario 2 is Charity B in Anytown, Georgia. And Charity B provides job training to income individuals in need of better paying jobs. Well, Lockhart Construction is a local company located in any town, and they believe that Charity B is doing a great job. They're really excited and they want to help. Lockhart provides Charity B with free space and equipment. Lockhart provides Charity B with an employee for free. Lockhart also donates a significant amount of money. Now, Lockhart has no connection, is not an insider, is not a founder, director, officer, no inside relationship, just really supportive of the mission of Charity B. Well, here's the interesting part. Charity B's training includes construction worker training, and Lockhart is a construction company. Charity B is able to send its training graduates to Lockhart for employment, which is great for Charity B. Their goal is to get people trained in construction and to get them better paying jobs. And this is really beneficial, though, to Lockhart, because Lockhart is getting trained new employees, and there happens to be a high turnover rate in the construction industry in any town. So there's not enough trained construction workers for Lockhart. So that's our scenario. So now let's digest this a little bit in terms of private benefit. Not talking private inurement, just private benefit. But before we get to that, you also need to analyze the public support test issues here, right? In any scenario, we need to look at how much is Charity B getting from Lockhart, and is it going to affect or tip that public charity support test that you need to meet? Because if most of the money is coming from Lockhart, it's then maybe looking a little bit more like the Ford Foundation or Bill and Melinda Gates Foundation, where it's only coming from a small group of people. All right, now let's talk about public benefit issues in this concept. So they're receiving trained new employees for their business. They've got a high turnover rate. It's difficult to find trained workers. Who is really benefiting here? Is Lockhart really benefiting, or is Charity B really benefiting? And what are the goals? And so you really have to look at that really closely. Is Lockhart's benefit incidental to the benefit that Charity B is accomplishing for its mission? And it has to be incidental. So you have to look at that and see, well, is that just a byproduct? You know, we're clearly helping these workers. We're training them. They're going out. They're getting better jobs. And by getting a job at Lockhart, we know that they're going to be successful. Are there other construction companies in any town that you could be sending these people to? And do you send them to them? Going back to my first scenario where we were talking about the counseling services and referring those clients back to counseling services. You have to make sure that you're expanding your network and that you're working with other construction companies that would be also offering jobs to those people. So the benefit isn't only to Lockhart. Because frankly, if Lockhart is giving significant donations of cash, if they're giving equipment, space, and employees, you really have to question, is it really a donation? Or are they really paying Charity B to train their employees, their new employees? And that it's really a service to Lockhart to train new employees for them. And in that case, you would also potentially affect your public charity status because you're providing a service, and if you're a publicly supported organization and not under 509A2, but under 509A1, that income may not qualify for your public support test. But it would be included in your income. So, so you really have to carefully dissect what is the relationship and how is it working, and are you providing more than an incidental benefit to that for-profit that's coming alongside of you and assisting in some way. These are really complex analyses, and you really have to kind of sit down and step back and do your due diligence and really think through these relationships. And if you're a client of Pro Bono Partnership of Atlanta, we're always happy to help you with some of these analyses involving private inurement or private benefit. All right, so those are the three different areas that we often see where we've got these closely related entities, for-profit and nonprofit. It's private inurement, public support test, and private benefit. And so in summary, you really want to watch for these close relationships with these for-profit entities. You want to consider how much the for-profit assists your organization and in what ways, and really break it down and think it through. You need to consider how close is that relationship. Is it with insiders or is it with outsiders? And if it's with insiders, is there a private inurement concern? And if it's with outsiders, is there a private benefit concern? And then finally, you need to consider whether or not these relationships and this income that may be coming in will jeopardize your public charity status. That concludes my remarks. Are there any more questions, Sarisha?
No, we have not had any further questions.
Okay. If there's any questions, we'll wait a minute and see if anyone types anything in. Doesn't look like anyone is. And so thank you very much. If you need more information on any of these topics.
We have one person typing in a question.
Okay, we have someone typing in a question. In the meantime, if you want more information on any of these topics, there's more on our website. And then, of course, if you're a client, please reach out to us for specific advice. And the question is?
Not appearing yet.
Okay, we'll wait an extra minute. Now we've got multiple people typing questions. I'd be happy to try and address them.
Nothing's been posted yet, so.
Okay. I'll wait one more minute. If it's a very specific, individually detailed question, you'd be better off just asking your respective pro bono Partnership of Atlanta attorney, and then we can address that issue